As dividend investors, we love to buy stocks at a discount. Value investors, however, love to get a super discount. They call it a margin of safety, and they want the stock to be extremely discounted before they will buy into a particular stock. And while all of us would love to get the stocks as cheaply as we can, today I want to talk a little bit about the pitfalls of value investing and whether we should have that as part of our portfolio or not. Also, I'm going to give you an update on the portfolio. So if you're interested in that, stay tuned. Hey guys, Kevin Burgess back yet again with another video, and today I want to talk about value investing. And who comes to your mind when you think of value investing? None other than Warren Buffett. So Warren Buffett, when he started out his career, was strictly value investing. He came across a guy named Charlie Munger who helped to shape his value investing thoughts. So today, let's talk about what value investing is, what the risks are, and whether it should play a part in our portfolio or not. Also, at the end, I'll give you an update on the portfolio and how it performed last week. So if you like this kind of content, if you're a dividend investor or a value investor and want to hear more content like this, just hit that like button if you would, and then subscribe to the channel. I'd love to have you along for the journey. And with that, let's get started. Okay, so let's jump in and try to answer the question, what is value investing? And value investing is an investing strategy that involves buying stocks that appear to be underpriced relative to their intrinsic value. There's a couple of terms here that we need to understand really well, and that is, what is intrinsic value and what is the margin of safety? And you know, one way to think about this is to kind of make it the analogy of when you're buying maybe a used car, right? So you will see a car, you drive it, you like it, you've tested it out, and you're willing to buy the car, but you really don't know how much it's worth. What is its value? So you go onto a site like Kelley Blue Book, and you'll do some research around that, and you'll find out what the value of that vehicle is, and that becomes somewhere around what you're willing to pay for that vehicle. It's the same with a stock. The stock has what is considered an intrinsic value. And you can get these intrinsic values from many different places. You can calculate them on your own. There are many different formulas. For instance, some people will use the price earnings ratio. I would caution against that. I think there's a lot about the PE ratio that does not work well when valuing a business. I would encourage you guys to look into things like discounted cash flows, or some of those types of valuing tools. But we're not going to go into that really today. I just wanted to give you that bit of a caution. So we're trying to determine what the intrinsic value is of a particular stock. I'll give you some suggestions here. So these are just some suggestions on how I look at intrinsic value. There's a website called Alpha Spread, and it's actually pretty good. It's got some different ways of looking at intrinsic value, and I'm going to be looking at 3M in these little clips here. So I don't own 3M, and I'm not going to talk about 3M's issues, but intrinsic value shown in Alpha Spread for 3M is $147.31. And it's showing a pretty nice, hefty margin of safety. And another tool that I use that is actually a paid subscription to Morningstar. And what I like about Morningstar's analysis is that they do give a fair value. And in this case, for 3M, the fair value is $183. And they're showing it at a 34% discount. But they also give a complete write-up on the stock. And it's really helpful to see and understand why they're coming up with the factors or the values that they're coming up with. Another tool I use is Fast Graphs, and while this doesn't really calculate a margin of safety like Alpha Spread or Morningstar does. It actually does show visually how the stock is performing and whether it would be considered at a discount. And you can see for 3M, also for Fast Graphs, it's showing at a discount, and that's a good indicator that this would be a value type investment, and it would be one that we would not only want to look at the information regarding the stock and just the financials and their history, but also we would want to look really hard at the management team and also the strategic plan, the strategic vision of the organization to make sure that we believe that they can really come out of the hole that they're in. So before we go too much further, let's move to the next slide here. Pitfalls for value investors. What are the pitfalls? I mean, it sounds like this is a great process, and I will tell you it is a great process, but the pitfalls are the intrinsic value. As you could see in the differences between Alpha Spread and Morningstar, there is an art to calculating intrinsic value. It is not strictly a science. There's a lot of factors in there, one of which would be the discount rate moving forward. So there's a lot of moving parts, and it's really up to the person who's calculating it as to what the intrinsic value is going to be. So don't think of intrinsic value as a specific number. Think of it more like a range, or a range in which you're comfortable buying the stock. The second pitfall is a stock is discounted for a reason. There is a reason the stock is selling that cheap. So it's our job as investors to find out why. It is our job to do our due diligence so that we understand what's going on with that company and what the uncertainties are that are driving the stock price down. And then the third pitfall is, how do you know how much margin of safety you need to compensate for the particular uncertainty that's causing the stock to be down? So there's a lot of pitfalls here that we can't just be a value investor and say, oh, the stock is underpriced, it's cheap, I'm going to buy it. There's a lot that goes into determining that we're going to buy a value investment. So now let's look at some of the risks. What are the risks for value investors? There's a high likelihood that value stocks will underperform the market in the medium term. There is a reason that stock is cheap, and therefore it's going to take some time to work it out. It could be lawsuits or the economy, or they could have corruption in the business, and it's going to take time for that stock to work through the issues that it has. So when you're buying a value investment, don't expect it to turn overnight. It's going to take some time. The second risk is that these underlying issues may actually be catastrophic. So it's important for us to understand those issues so that we can make the proper determination about whether we believe that they are catastrophic or not. And then the third risk is that the margin of safety that we calculate may not be sufficient, may not be adequate. And therefore, the stock continues to go down and leaves us with an investment that is not performing very well. Now, I will say that value investing is an important part of everyone's portfolio. It's really important to understand when a stock is selling really cheaply, more cheaply than it really should be. So I'm going to share with you 5 investments that I've made that have been on the value side and how they've performed for me. So as you can see here, I have 5 value investments. One of them is Stanley Black & Decker. I started buying Stanley Black & Decker, I don't know, about 6 or 8 months ago, and I was way too early to that party. As you can tell, my performance it's down 37%. And it looks like it's going to be down for a while. But I do believe in Stanley Black & Decker, or I wouldn't still own them. But it's going to take a while for that one to turn around. So Whirlpool also is a value investment that I was a bit too early on. And you can see it's down 25%. I do believe that once the economy begins to improve, and that may be 2 to 3 years from now, that we're going to see both Stanley Black & Decker and Whirlpool perform very well. But the point from earlier is it's going to take a while. It's going to be a medium term. I've just got to be patient with these investments. There are 3 others that I bought, however, who have already turned around. One is Chevron, and as you recall, it's been a couple of years ago, but all of the oil stocks were in the basement. They were in the doghouse with investors. So I picked up some shares of Chevron during that time. They are up now 52% in my portfolio. AbbVie, there was a lot of uncertainty around their drug Humira. So I picked up some shares of AbbVie around that time, somewhere around the 108, 106, 108 price range. And now they're up 46% in my portfolio. Lockheed Martin, I don't know if you recall this, maybe a year and a half ago, they had an earnings call and it didn't go very well because the analysts were not happy with their message. But their underlying business didn't change. So I picked up at that point Lockheed Martin, and it is up now by 42%. So value investing is an important part of everybody's portfolio, but recognize that it's going to take some time for those investments to give you a return. And it's also important to understand what you believe their intrinsic value is and what margin of safety that you need to make that particular investment and whether it's cheap enough yet for you to do that. So let's wrap this up. Does value investing play a role in our portfolios? I would say absolutely it does. I mean, we're always looking for a deal, but when you're looking for a stock that has deep discount and what I call a deep value stock, we need to be serious about our due diligence. We need to understand what it is that's causing the stock to be discounted and whether or not there's a likelihood that the company is able to pull out of it. So they would pull out of it in maybe two ways, one of two ways anyway. They would have a good strategy and they would have a good solid management team. Those are two critical aspects when you're looking at a deep value investment. Don't shortcut that due diligence. It's important to your portfolio. And secondly, you're not going to win all the time. You're going to pick some deep value stocks and they're just not going to do well for long periods of time. So hopefully that was helpful to you. Let's go ahead and look at the portfolio for the week ending December 16th. You can see we had a great week in dividends. Look at that, $2,265.91. Phenomenal week in dividends this week. The market price, however, went down about $10,900. So the performance of the portfolio from a market perspective was down 1.2%. The S&P 500 is down 2.1%. So we did, at least outperform the market. So let's take a look at year to date. We are year to date now down 3.2%. With the S&P down now 19.7%. And in total return, you can see that the portfolio is up 0.4%. After including dividends and options. One other thing to point out quickly here is that the portfolio has gotten $28,000 in dividends. This is really a good example of why I love dividend investing. It provides a return for us as investors. And maybe I should do a video on all the things I like about dividend paying stocks. I'll put that on the list. Well, that about wraps it up, guys. I hope you guys have a wonderful Christmas and a happy new year. As we look forward to 2022, let's go ahead and begin thinking about what our goals are for 2023. I may have said 2022, but for 2023, what our goals are for the coming year. If you wouldn't mind, share some of those goals with me in the comments below. It's time for me to start revamping my goals. I need to refresh what my 2022 goals were and determine realistically whether I met those or not, and then build some new goals for 2023. So with that, I'll see you on the next video.